Hello class and welcome to the first video on chapter 12, capital budgeting. So up until this point in class, we've been talking about how managers make decisions for cost on production of products and how it is going to affect their net income. So now we're going to change gears again a little bit and talk about capital budgeting decisions. So what are those? Well, those are decisions that we need to make on whether or not maybe we should expand the plant, make a big expenditure and a big investment and expand. What kind of equipment should we buy, or should we just repair our equipment? Okay, what's more cost effective? Should we lease a piece of equipment, or should we buy it? Stuff like that. So we're going to be making big decisions that companies have to make that necessarily doesn't affect profit. Maybe capital expenditures. We're acquiring large amount of assets. Okay? So the major difference between what we've been doing in the past, what we're doing now, is always in the past we've been looking about how the change is going to affect the company's net income. But we're not going to worry about net income at all during this chapter. What we're more concerned about now is cash flows. Okay, are we going to have positive cash flows if we make this investment or this expenditure? Okay. So as we get going, what we're going to do here is we're going to look at a bunch of different things for capital budgeting decisions, and they kind of fall into two broad categories. The two broad categories are screening decisions and preference decisions. Okay, so this video we are going to only deal with the screening decisions. So screening decisions means does if we decide to do this project, buy this piece of equipment, expand the plant, whatever we decide to do, is it going to meet some kind of company standard? Usually that company standard is some kind of rate of return. Okay, that is also going to be termed as the discount rate, but most often in practicality, it is the weighted average cost of capital. So if you move on in your educational career, you in some higher up finance classes, you're going to learn how to calculate weighted average cost of capital. That just takes into account how much of the company is in equity, how much of it is in debt, what each investor expects to get in return for their investment, and kind of averages it together. And that is usually what is considered the discount rate, or what the amount of return a company needs to make in order to keep its investors happy. Okay. The preference decisions, that is when we're giving several different alternatives and we have to decide which one we want to do. Those are the lease or the buy, or maybe we have three different pieces of equipment that we have opportunities to buy at different prices, different payment options and stuff like that. We wanted to figure out what is the best option for us. Okay. This is actually one of my favorite chapters to teach, and I wish I could be there in person to do this with you guys because there's a lot of auxiliary uses for this. But one of the things we're going to go over in this chapter is time value of money. Time value of money basically means that having a dollar today is worth more than having a dollar tomorrow. And the reason that is because of interest, and specifically compounding interest. So I don't know how aware you are of how interest works. Let's say we had simple interest and we deposited $100 and we got a 10% return. So every year we are going to get 10% of $100, or we're going to get $10. So at the end of year one, we have $110. End of year two, we have $120. Compounding interest is going to put interest on top of interest. Okay, so if we have a 10% return and it compounds yearly and we put in $100, at the end of year one, we're going to get 10% or 110. At the end of year two, we're going to have $110 in now in our account now, and we get 10%. We are actually going to get $11. So at the end of year two, we will have $121. And then we will get 10% at the end of year two. So we will get $12.10 in interest. So instead of the simple rate of 10% on the $100 every year, the compounding interest makes it grow exponentially. Now, if you're an investor and you have something in and it's compounding for you, it is a great investment. Now, if you're a debtor and you have to pay something that is compounding on a yearly or even monthly basis, it can really make those interest expense add up. I'm actually going to do an auxiliary video that's going to have nothing to do with the homework, but I think it's going to be a great real life application. I'm going to show you how car loans work using the time value of money, and maybe you get an idea of exactly how much interest you're paying if you go to buy a car at 5 or 6% interest or whatever kind of rate you may get. Okay, but the time value of money, what that does is it takes all the cash flows that we're going to get in the future And as I said, $1 today is worth more than $1 in the future. So if we're getting $100,000 3 years from now, what it's worth today is going to be less than that $100,000, because we could take that money and invest it and get some kind of rate of return and build it up to that $100,000. Okay, so taking what we expect to get in the future and bringing it back to today's terms is called discounted cash flows. That's why we use the discounted rate to calculate our discounted cash flows. And as we start working through some problems, hopefully this will make more sense. Okay, but there's just kind of a broad overview of what we're going to do. So I'm going to move my computer up and get where I can get by the screen. Okay, what the problems I'm going to work through in this video are just based off the PowerPoint presentation. Okay, the second video that I'm going to do, I'm going to work through some homework questions with you off of the handout that I put on Moodle. But one thing you will want to have available to you while you're watching this video is there's 2 PDF files that I put in the Chapter 3 handouts that are present value table and a present value of an annuity table. They look like this. Okay, so there's 2 of them. You are going to need them. If you're watching the lecture, it's nice to have them in front of you whenever you're doing the homework and the test and stuff like that. The computers are going to give you links to these charts, but this has to do with time value of money, and I'll explain them here in just a minute. So go ahead and get that ready while I get my computer ready. And we'll start talking about the 1, 2, 3 different types of screening decisions that companies make. Okay, so our first example here is the easiest example. It's really nice to get through, but it has a lot of limitations. And it's called the payback method. Okay. Under the payback method, all we are trying to figure out is how long it is going to take to repay the initial investment in whatever we decide to invest in, buying a piece of equipment, the cost of expanding the plant, whatever it may be. The good thing about the payback method is all that stuff I talked about the time value of money and discounting cash flows does not apply when using the payback method. You were just looking at the natural cash flows when they come in, and you're just going to calculate how long it is going to take to pay it back. And then usually, as I said, it's a screening decision, so it's some kind of company standards. The company might say you need to pay this back in 5 years. You need to be able to pay this investment back in 10 years off the cash flows we're going to generate from it. Okay. So a simple example from your slide, okay? Coffee company is going to buy an espresso machine. The cost equals $140,000 to buy this machine. Okay. Management requires a 5-year payback period. So as an accountant, we do some analysis. We buy this machine. We determine that we are going to sell more coffee, and we estimate that we are going to generate annually our annual cash flow is going to equal $35,000. So it's going to cost us $140,000 annually. We are going to make $35,000 off of it. So are we going to pay it back in 5 years? When all of your cash flows are the same and you have an average and annual just estimate like this, you can take your total cost divided by your annual cash flows, and we find out that if we did this, it is going to equal 4 years. So we'd be able to pay back the cost of the espresso machine in 4 years, Management has the criteria of a 5-year payback period. So in this case, yes, you would want to go ahead and buy the espresso machine. It meets the management criteria, so it would be a good investment. Okay. So there, that is just a simple example when stuff are put out on a just an average basis, but most of the time cash flows do not fall on an average basis. Okay. So a little different kind of example is this. So we have two investments here, or two alternatives. In both of them, our initial investment was $100,000, but they have different expected cash flows into the future. Okay, so for investment number one, they expect to get 60,000 in year one, 40,000 in year two, and then no cash flows in year three. On the other hand, if they did investment number two, they would get 60,000 in year one, 35,000 in year two, and 25,000 in year three. Management has a 2-year payback period requirement. So in this case, which investment would they take? So you can see here the initial investment was 100, year one, 60,000, year two, 40,000. They cover that in year two. Here we only have 95,000 that comes out for year one and two. So it is not all covered in year two. To find the remainders, we have, so when you add these up, this is 95. The initial investment was 100,000, so it still took 5,000 more to recover. We made 25 for the year. 5.2. So it would take us 2.2 years. See, just a little bit over. You're not going to need to calculate the 2.2 years, but I want you to understand the point here is that this one is going to take a little bit longer to pay back. But which one would actually be the better investment? I would say it would be option number two here, because even though it takes just a little bit longer to pay back, you are actually making in real money, not discounted money, $20,000 over your initial investment. And in this one, you're just recovering your initial investment. Okay. But if the only criteria management has set forward is it has to be paid off, the investment has to pay back in 2 years, you would go with option one. So that is the positive of the payback period. You can find out which one of these you can pay back the quickest, so you know you're going to recoup your initial investment the fastest, which is sometimes is very valuable to investors. But the negatives, it ignores the time value of money. So we're not discounting these back to what they're worth today. And so it makes a big difference because your rate of return and stuff like that, what you could do if you have that money today. And then secondly, maybe more importantly, it ignores all cash flows that happen after the payback period. We could go on, but in year four, this thing was still going to generate $25,000 for another for year four, year five, year six. Okay. If we're just doing the payback method, that does not take any of that into consideration. All right. So there is the simplest example of screening decisions and the payback method. Okay. So the next kind of screening decision we have is called net present value. Okay. NPV is how you will see me abbreviate net present value. So what we are going to do here is we're going to have to use discounted cash flows and the time value of money. So let me talk about the time value of money really quick. Time value of money states, as I said before, that $1 today is worth more than $1 tomorrow. So we're going to have a discounted cash rate. So we're going to have to take all the cash flows that we receive in the future and discount them, make them lower back to today's prices. Okay. There are two types of things we're going to have. There's lump sum. That is a one-time payment. And then we have annuities. Annuities are the same payment or inflows or outflows that happen at the same amount at the same time, okay, over the same period. So it could be every year, every 6 months, okay? Lump sum is when the payment or the inflow happens one time, okay? So the time value of money, we are going to have some things we're going to have to find in order to calculate this. I'm just giving you some terms up here. So when I start writing stuff out, you'll know what I'm putting and what they'll mean. Okay, so as we're going to go through and start figuring out these things, you are going to need to know some of this information for each of the problems, okay? So present value, which will be noted as PV, okay? That is what it is worth today. If we paid it today or we get an inflow today, it is already at its present value. It is going to happen sometime in the future, which is an FV, a future value, a dollar amount that is going to inflow or outflow that is going to happen in the future. It needs to be discounted back to its present value. Okay. Payment is if we have an annuity, it is the same inflow or the outflow that happens on a regular basis with an annuity that is going to be denoted as a payment. So in order to calculate what our discounted cash flows are, we are always also going to have to have an interest rate always. Okay, this is going to be what I was talking about with the discount rate. It will say the discount rate or the implicit or the company's rate of return. Whatever it is, our interest rate, it will always be denoted as an I. And then periods. For the purpose of this class, it's going to be years. Okay, so our years will be denoted as an N. So to get the present value of a lump sum, so a one-time payment. So the present value of a lump sum, it equals the future value multiplied by this nice big, oh, correct that, future value divided by this nice big formula here. 1 plus I raised to the nth power. Okay, so it's 1 plus the interest rate raised to however many periods that the thing is set out for. This right here is also known as a factor. That is why you have your charts. So the chart for a lump sum, we are looking at the table that just says present value tables. You might see one, it might say present value of 1, but it does not have the word annuity in it. All this stuff out here, so instead of having to do the algebra for this little part right here, that is what your factor is. It is all broke out into this chart. So if you can find your I and your N, You can go on your chart here, I and your N, and just go across, match it up, and you will find the number that plugs in on the bottom right here. If we want to find the present value of an annuity, this is the payment multiplied by, now this is even a more fun equation, but it's good we have a factor for it. 1 minus divided by there would be your algebraic formula to calculate how to get a present value of annuity. The payment multiplied by that out. But once again, this whole part that's in the parentheses here, it doesn't have to do with the payment, is called your factor. And if you go to your annuity tables, the one that says annuity on it has different numbers, and it'll have all of those calculated out for you. You are going to use this again and again and again if you're going to do any kind of finance class or any kind of accounting classes moving forward. If you plan to, I highly suggest you get one of these. It's a BA2 Plus Business Analyst Calculator, and if you can see these white buttons right here, it has the PV, the FB, the payment, the N, and the I. Simple, just because as you see, as we're going to start doing the problems, what we're going to do is we're going to pull these out and see what we have. And then we're just going to plug them into these two formulas to discount it back to its present value rate. Okay, so if we have a payment, we're going to know the payment times the factor, which we are going to find on the chart, equals our present value. If you have one of these calculators, you will never have to have one of those charts because you can just punch it in and it'll calculate all that stuff that's already pre-built. Okay. This is one of the more difficult concepts, but also one of the more fun to me. We go over this again in my intermediate accounting 1 class during last semester, and it is always one of the more difficult because this is how we calculate bond prices and a bunch of other things. Time value of money has so many applications. It is really an amazing tool, something great to know. So let's try working through a problem and see if I can take what I put up here and make it make a little bit more sense. Ooh. For some reason, I did not put the thing from the slide on here. So first little screw up here, what I'm going to do is we're going to go through the first one on our handout, okay? So if you get your pause it, go ahead and get your handout ready. And we will go through that first problem there. It says the management of Kunkel Company is considering the purchase of a $27,000 machine that will reduce operating costs by $7,000 per year. At the end of the machine's 5-year useful life, it will have 0 salvage value. The company's required rate of return is 12%. Determine the net present value. So our net present value is going to equal the present value of the inflows minus the present value of the outflows. And we want that to be a positive number. Stuff we know. Our present value, stuff that we have to pay today, is $27,000. Okay, it's actually a negative. We paid out $27,000. That is an outflow. The payment amount, okay, we're not actually receiving cash, but it does tell us that we are going to reduce operating costs by $7,000 a year. So if we reduce costs, that is basically like an inflow of cash because this cash is not going out. Our payment is $7,000. Our interest rate is given. The company's required rate of return is 12%. So you can see it as a required rate of return. It could say the company's discount rate, company's implicit rate of return, however it's worded, look for their rate. And our period is 5 years. Next, so there's all the information we need. We can go through and plug it into here. Let's start with our outflows. If we have one of those, it is $27,000. It happened today. It is at its present value already. So our outflows is all we have, $27,000. Our inflows, we looked at. We have one inflow. Does it happen one time? No, it happens continuously year after year after year, so it's an annuity. So our present value of an annuity equals our payment times the factor. Okay, so our present value is what we don't know. Our payment was $7,000. Our factor, we had to base it off the interest and the period. So we have an I of 12 and N of 5. You go to your present value of an annuity table, which is this one right here, and you look at 12% in 5 years and see where they match up, you will find a number of 3.6, 048. When you do that math out, you will find the present value of annuity equals $25,235. So the present value of our inflows are $25,000. The present value of the outflows are $27,000. It is a net loss on this project, so it is not something that you would want to do. So hopefully that example helps the time value of money make sense. When I get ready to do my second video for this chapter, I will go through another example of this so you can see it again. Good luck, and as always, don't forget to reach out to me if you have any questions.